Hi, welcome back to Joe Blogs. This video is the next in a series looking at the financial implications of Russia's invasion of Ukraine on the global economy. And in today's episode, I want to talk to you about a natural gas price cap. Now, if you've been following the channel, you'll know that the European Union introduced an oil price cap against Russian oil on the 5th of December. And that cap is really focused on the shipping of that product. But the situation with regards to natural gas supplies is a bit more complicated because the gas that Russia had been selling directly into Europe was coming through the pipeline infrastructure that Russia had built. However, the gas price cap that we're talking about now relates to liquefied natural gas. So in today's episode, I'll run through the oil price cap, exactly how that was structured, why it was put in place, and how it's operating. We'll then talk about the proposed natural gas price cap, how that's going to operate, and why it's very different to the oil price cap. We'll then have a look at the natural gas price chart to see how often this proposed cap would have kicked in over the course of the last 12 months. And then finally today I'll go on to my summary to talk about whether or not I think this price cap is going to work, because this is very different to the oil price cap. The oil price cap was brought in specifically to stop Russia earning excessive revenues. The natural gas price cap is different because Russia is not the dominant supplier of natural gas into Europe anymore. So this price cap is going to apply to every other country. So this isn't just a penalty against Russia. This is trying to stop the whole of the world overcharging Europe. And that, I think, is going to be very difficult. So before we get into all of that, if I could ask you to give me a thumbs up at some point during this video, if you're enjoying the content, please subscribe if you haven't done so already. Don't forget, I always include chapters, so if you haven't got time to watch everything, you can skip over stuff. And if you'd like to support the channel, please have a look below where you'll find links to YouTube, super thanks and membership, as well as Buy Me a Coffee, Patreon and Amazon shopping links. And once again, I'd like to say thank you so much to everybody that has supported the channel during 2022. Really appreciate your support. On the 5th of December, the European Union introduced an outright ban on the purchase of all Russian oil. And in addition to that, the G7 plus Australia and the EU introduced an oil price cap against all seaborne transport of Russian oil. Now, the reason that the oil price cap was introduced was to prevent Russia from earning excessive profits on the sale of its oil, as an incentive to get Russia to stop the war in Ukraine. That's what it's designed to do. So if we take a step back and look at the fundamentals of this. Firstly, Europe has banned the purchase of all Russian oil, apart from some exemptions that are still allowed for countries that are landlocked, that are having difficulty sourcing alternative supplies. And in addition to the European ban, the G7 and Australia has also stopped buying Russian oil. Now, the reason that the cap was introduced was to try to regulate the sale of Russian oil to all of the other countries in the world, because obviously Russia still is producing large amounts of oil. It wants to sell it. It's been offering that oil at a discount in the markets, and that discount has ranged between 20 and 30% against the market price. Now, the cap that's been introduced has been set at $60, which equates to roughly a 30% discount against the current market value. So essentially what the European Union has done is formalise the discount that Russia has been selling at. It's allowing it to do it on a legalised basis. And the way that this cap will be enforced is through the shipping of the oil, because Russia will need to load all of that oil onto tankers. So firstly, it needs to find a lot more tankers than it's been using historically, because most of that oil was going through the pipelines into Europe. And a lot of those ships are owned by Western companies. In addition to the ships, it also needs insurance for those ships, and a lot of the companies that provide that insurance also come from the West. And in addition to the insurance, it needs other shipping brokerage services, and again, that's supplied by a lot of the West countries. So the way that the oil price cap operates is that all of the companies who provide those services that Russia need will only be allowed to supply them if the deals are being done at either $60 or below. If the oil is being sold for above $60, that will invalidate all of the insurance and mean that those shipping companies would not be prepared to allow their ships to be used by Russian businesses. So there is an effective way of this being put into place. Now, obviously, Russia has said that it's not happy with this oil price cap and that it won't supply oil to any country that signs up to it. But it's a really delicate balancing act, because as I've mentioned before on the channel, Russia needs to keep producing that oil. If it stops its production, that will cause it major problems. A lot of Russia's oil fields are in inhospitable places, in areas where they have very cold climate. And if you stop that flow of oil, that could result in really serious problems, and it may be very difficult to get the flow started again. So Russia really doesn't want to cut back on its production, but it needs to find markets to sell that oil into because it doesn't have anywhere to store it. So whilst Russia is saying that it doesn't want to agree to the cap, if every country in the world does sign up to it, it really won't have any choice because that will be the only deal that's on the table. And as it stands right now, the oil price cap has been in place for around 2 weeks, and we don't really know how it's playing out just yet because a lot of the oil that's being transported right now relates to deals that were struck over the course of the last few months, so before the oil price cap actually came into effect. So it will only be over the course of the next couple of months that we will be able to see how India and China and the other major nations around the world outside the G7 and Australia and Europe are reacting to this cap. But as it stands right now, the cap's in place. It's very clear how it works. It's $60 or below for the deals. If it's above that, then Russia is in violation of that cap, and therefore it shouldn't be able to access the ships or the insurance or the brokerage services. And one of the main reasons that the oil price cap has been universally accepted by everybody is that it only affects Russian oil. Nobody else is impacted. If the market price of oil goes to $200, everybody else can sell their oil at $200. Russia would still be locked into that $60 cap. So it is quite penal from Russia's perspective, but from everybody else's point of view, it has no bearing whatsoever. This chart shows the movement in the price of natural gas in Europe over the course of the last 5 years. And as you can see, over the last 12 months or so, there has been a remarkable increase in the cost of gas. In June 2021, 1 megawatt hour of natural gas cost around €20. Now, as Europe came out of lockdown and demand for energy increased, the price of natural gas rose significantly. And by the 21st of February, prior to Russia's invasion of Ukraine, 1 megawatt hour was trading for around €75. Now, at that point, Russia was the single largest supplier of natural gas into Europe. It supplied a lot of countries directly through pipelines. And directly following the invasion of Ukraine, the price of natural gas jumped to above €225 per megawatt hour, which represents an increase of around 10 times the price that gas was trading at back in June 21. Following the initial spike in price, prices came down to around €100 per megawatt hour. However, during the summer months, natural gas became a major political topic and something that President Putin used to apply pressure against the other nations of Europe. A number of countries had their supplies switched off, and the amount of gas that was flowing through the Nord Stream pipeline was reduced significantly. And by the end of August, 1 megawatt hour of gas was trading for €343. Now, that price has subsequently come back down due to a combination of factors. Firstly, the nations of Europe have been able to source gas from other suppliers. So a lot of countries have been working very hard on putting liquefied natural gas infrastructure in place to enable them to buy LNG from countries other than Russia. And secondly, there's been a slowdown in the global economy, which has meant a reduction in demand for energy products, and therefore prices have come back down. Very simple economics tells you that when demand falls, you see a reduction in price. And the price of 1 megawatt hour of natural gas in Europe is now around €100, which is obviously still high compared with the long-term average of around €20, but is significantly less than €343. Now, the reason that natural gas is so important to Europe is that a lot of the European countries have built their infrastructure around it. Over the course of the last 30 years, there's been a movement away from coal. So in the past, a lot of countries were using coal-fired power stations, but because of the drive to reduce CO2 emissions, a lot of countries moved to natural gas-fired power stations, as natural gas produces around 50% less CO2 than coal. And because Russia has large supplies of natural gas and is the world's largest exporter, it built infrastructure all through Europe to pipe that gas directly to all of those power stations. So that situation worked fantastically well over the last 20 years. But since Russia's invasion of Ukraine, most of the countries of Europe came out and stated that they no longer wanted to buy that gas for political reasons. They didn't want to keep giving billions of dollars over to President Putin to finance his war. And the huge increase in natural gas prices that we've seen over the course of the last 12 months is causing major problems in all of these European countries, because it's very difficult to switch all of your infrastructure away from natural gas to other sources. And so all of these countries are having to keep buying gas at these elevated prices. And this is putting real pressure on the economy. So as a result of this, the European Union has now introduced a natural gas cap. So the 27 countries of the European Union have now agreed on a natural gas price cap. Now, this is something that's been in discussion for the last 6 months or so. As I mentioned earlier, a lot of countries in Europe have huge exposure to natural gas. So this is one of their biggest purchases. And this is causing major problems for a lot of the economies because costs have risen. And of course, if the cost of electricity and energy products is going up, that feeds into the price of everything, because all of the companies in your country will be using energy to produce whatever they're making, and therefore they will need to pass on those increases in their prices. So it's making them potentially less competitive in the global markets. So this is a really big problem, but it's also a major problem for consumers. As we just saw, the price of natural gas has increased by around 5 times the long-term average over the last 12 months. And of course, most people haven't had an increase of anything like that in their wages. So it's increasing the cost of living and reducing the standard of living. So in order to try and address this, the countries have now introduced a price cap. Now, the natural gas price cap is different to the oil price cap because it's going to fluctuate. But the way that it's been set out initially, the initial price has been benchmarked at 180 euros. If the price of natural gas in the international markets rises by more than 35 euros above that benchmark, so essentially 215 euros, that triggers the price cap, and no country of the 27 in the EU will be able to pay more than that in the international markets for gas. So essentially, they're setting an upper ceiling on the price of gas. Now, as I mentioned, this price cap can fluctuate. So the benchmark of 180 can be moved. So in theory, if international markets move to, say, 400 euros per megawatt hour, then the benchmark could be increased from 180 to, say, 250. And then all of the European countries would have a new benchmark that they can pay. So the way the price has been set is different to the oil price cap. The oil price cap is very simple to understand. It's set at 60 euros for Russian oil, and nobody can pay above that rate. But the other big difference here, and I think this is the fundamental issue with the natural gas price cap, is that this is applying to the sale of all natural gas. It's not being applied just to Russian natural gas. This is gas that anybody is selling. So US gas, Qatar gas, any gas that you can think of. And that means that the European Union is therefore enforcing a price cap on every country in the world. And I think that's a fundamental flaw in the way that this is going to work. Because why would the USA and Qatar agree to sell their gas to the European countries at below the market rate, which is essentially what this cap is doing? It's saying we don't want to pay more than a certain price in the international markets, and we're not going to. So therefore, everybody has to agree to our terms and conditions. But obviously, if there's demand from other countries in the world, the EU can't enforce all of those countries to comply with its price cap because they're not in the EU. They haven't signed up to that collective agreement. And the other issue that we need to think about is the supply of energy. Because the reason that the price of natural gas has risen so much over the course of the last 12 months is because it's got inelastic demand. And inelastic demand is a situation where you will pay virtually any price for a product. So a good example of this is cigarettes. If you're a smoker and you need cigarettes, if somebody increases the price of those cigarettes by 10% or 20% or 30%, it's likely that you will still buy them because you want those cigarettes, you need those cigarettes, and therefore you're prepared to pay virtually any price at all. Gasoline is another good example of inelastic demand. Most consumers need gasoline and they will pay whatever price is at the pumps. They won't be happy about it if it goes up 10 or 15 or 20%, but people will still pay it. And in fact, when you hear that there's a potential shortage of gasoline, there's usually queues all around the block. People will rush to the stations to fill up their vehicles. They don't care what the price is, they want that gasoline. So when you have a situation with inelastic demand, price is almost irrelevant because you need to keep buying. And that's the situation that Europe has found itself in over the course of the last 12 months. Because the infrastructure has been built around natural gas, The countries need to keep buying it in, to keep producing electricity, to keep the lights on for everybody. Otherwise, these economies will go into meltdown. But the way that this price cap has been structured, European countries will not be able to buy natural gas if the price goes above a certain level and the suppliers say, well, actually, we're not prepared to give you that gas at the price that you want to pay. So that would mean that all of those countries would then be out of gas, which would mean they wouldn't be able to produce electricity and they wouldn't be able to give it to consumers to heat their homes and for cooking. And that is going to be a major problem. So the big question is, will the European countries stick to this price cap if countries like the USA and Qatar decide to play hardball and say, actually, we'd prefer to keep our gas rather than selling it to you at a major discount to the market price? This chart shows the origin of liquefied natural gas imports into Europe over the course of the last 12 years. So if we focus in on 2021, because that was the current situation prior to Russia's invasion of Ukraine, you can see that the biggest single supplier of LNG was the USA, that's shown in the red section of this chart. The second biggest supplier was Qatar, and those two countries represented around 50% of all of the LNG that was bought by Europe. Russia was the next largest supplier, accounting for around 20%, followed by Nigeria and Algeria. So when you take a step back and look at the overall position here, 80% of all of the LNG that was supplied into Europe in 2021 was supplied by countries other than Russia. And this chart shows both historic and projected supply and demand of LNG globally. And this shows that there's been a significant increase between 2019 and 2022 in global demand. And that increase is forecast to continue over the course of the next 4 years. So what this data shows is that there's a growing demand for LNG globally. Europe simply doesn't have a monopoly over the demand for liquefied natural gas. So what's the summary and conclusion today? Well, I wanted to post this video because the news of the natural gas price cap has just broken, so I wanted to share that with you to make sure that you're in the know. But my concerns about this natural gas price cap is that it's very different to the oil price cap. The oil price cap was structured to stop Russia earning large amounts of profit on all of its oil. And the main reason that it could operate is that firstly, a lot of countries have banned the purchase of Russian oil. So there is a limited market now. Only the countries that are outside the EU, the G7 and Australia are in the market for buying any of that oil. And they've been buying it over the course of the last 12 months at a discount. And the way that that price cap was structured was really to formalise that discount, to allow all of those countries to carry on buying at the reduced levels, as long as it's at a price of $60 or less. And the reason that that price cap could work is that firstly, it only applies to Russian oil, so it doesn't impact on any other oil producer around the world. And secondly, that oil needs to be shipped, so Russia does have a desperate need for those vessels and the insurance that goes alongside it. So therefore, there is a way of being able to enforce it. Now, as we've just discussed, the natural gas price cap is an entirely different animal. This has been structured by the European Union for their own purposes. They don't want to pay over a certain price because inflation is out of control and the European countries are trying to bring costs back down. And a good way of doing that would be to limit the price that they're paying for natural gas, because that is one of the reasons that inflation is so high right now. But the fundamental flaw in the way that this price cap has been constructed is that the majority of the supplies for LNG globally are coming from countries other than Russia. So this isn't applying to one country. This is a market cap that's being enforced by the buyers. Normally, if you have price controls in a market, they will be determined by the suppliers. So OPEC is a good example here. This is 13 countries that produce oil around the world, and collectively they decide what volume of oil will be produced, and those volume limits have an impact directly on the price. So that's how that works. But when you're the buyer, you don't really have a lot of control over the price. The price is set by demand and supply. So if demand rises for something, then the price will go up. And that's exactly what's happened to natural gas over the last 12 months. Demand has spiked at the same time as supply has contracted because all these European countries don't want to buy Russian oil and Russia doesn't want to sell it to certain countries. So we've had a perfect storm from that perspective. But the problem that the European countries have right now is that they're telling the rest of the world, we won't pay above a certain price if prices rise really rapidly. But the reason they're going to rise really rapidly is because demand will increase or supply will contract. They are the fundamentals of why price is moving. So what the European Union is saying through its cap is counterintuitive. They're saying if demand increases across the world or supply contracts, then we're not prepared to pay those high prices. But why would the suppliers agree to that? Because they're giving over a natural resource that they own that's in limited supply, and they will effectively be selling it at a reduced price to Europe if they agree to that price cap. So whilst this is a good idea from Europe's perspective, it doesn't really look very attractive from any of the suppliers of LNG. And of course, these countries are having to invest huge amounts of capital into their infrastructure to increase their capacity, to try to produce more LNG for Europe. But if Europe then turns around and says, actually, we don't want to buy it unless we can have it at a massive discount, we may well find that Europe doesn't get those supplies. And then the big question will be, will Europe follow through on this cap? Will they stick to their guns and say, if you can't sell at that price, we're not buying? Because if they do that, there will then be a potential energy crisis in all of those countries. And as I've discussed previously, all of the European countries have recently filled all of their gas reserves. So everybody's sitting with nice full reserves for the winter of 2022. But the problem is for next year, how are they going to refill those reserves? Because Russian gas is no longer being supplied. They'll need to use LNG to fill all of that capacity. And if the price rises above this cap and the suppliers say, we're not selling at that price, will the European countries be prepared to break their cap, to abandon it, to get those stores full? Or are they prepared to go into the winter of 2023 with no storage, gambling on prices coming back down? So I think it'll be really interesting to see how this cap plays out, whether or not it becomes effective. It's fine at the moment because prices have come back down and it's not in place. It's not operational. But the big test will be if those prices start to rise again over the course of the next few months and they trigger through the €180 level, will the European countries stick to the cap or will it be scrapped? Only time will tell on that front. But hopefully you've enjoyed today's video. You found it useful, informative and thought-provoking. If you've liked what I've said, please give me a thumbs up and don't forget to subscribe if you haven't done so already.